Hey guys, it's Willie. Today I want to take a look at Honeywell International. This company is a lot like a GE, if you will. They're a multinational conglomerate corporation. They're just a big company. They do a lot of different things, a lot like GE. Well, GE's broken up now, so they're a bit different, I guess. Honeywell is, I would assume they're a lot like a 3M. Something along those lines, but really big company that does a lot of things. Good to know that they are located in Charlotte, North Carolina, which just so happens to be about 15 minutes down the road from me. Didn't know that. Anyway, my tangent is over. Currently, 197 is the current stock price. Year to date, you've seen minus 4.7 over the past year. You're looking at minus 12.5%. Not something I expected to see out of Honeywell, but again, as value investors, we really look at stocks that have seen little love, and so we've seen this. You're looking for a drop in price where fundamentals have not dropped. You're looking for an irrational drop in price as a value investor. So let's switch over to here and look at our financials. And really quickly, I'll make this a bit bigger so everybody can see it. Honeywell, HON, stock ticker, price 197, as I said. Revenue, net income, and free cash flow, the metrics that we always love to start with, free cash flow being my personal favorite. But anyway, revenue is a bit strange with Honeywell. You're going from about $37.5 billion to $34.5 billion, roughly. I don't know why you've seen a drop. It seems like until 2018-ish, you were seeing trending upward. 2019 hit and it started falling down. I don't know why. That's something to check into if you're interested in Honeywell. Net income and free cash flow have not seen that happen, which is something that is a bit strange, that free cash flow and net income are not following revenue, since net income and free cash flow come out of revenue. So I don't know how they're managing to grow net income and free cash flow and not revenue. Don't know about that one, but net income looks good. There was a blip in 2017. Right here. I don't know what that was. Don't know what that was for. Make sure that's okay. Free cash flow. I don't have a whole lot to say other than it's been kind of trending downward here recently. But overall, they've been able to grow it at, about 7% a year for both net income and free cash flow. Not bad. Can't complain. Shares outstanding, we want these coming down. They are coming down. They went from almost 800 billion to 700 billion. That's a little bit over 1% a year. Still, that's great. Fantastic. Increasing our percentage of ownership in the business. Earnings per share, free cash flow per share shooting up fast because the underlying free cash flow and net income numbers are going up and shares are going down. Dividing a bigger number by a smaller number means you get stellar growth in the per share department. Moving on, total assets. Honeywell has a reasonable amount of assets for such a large company. They do, they have a lot of assets. Not something I really care about, but I put it on here for those who are interested in it. Dividends are here. An okay metric to look at is just looking at the growth over long periods of time of the dividend. Looks pretty good, especially from 2013 onward. It's grown steadily. I think Honeywell is one of those companies that should be able to grow their dividend steadily over time, which is a good sign for future prospects of the company. Debt is where I start to get a bit concerned. Debt is growing at about 4.5% a year. Cash, which is growing at 9.5% a year. Good job, you're growing cash faster than debt. Okay, that's good. Take total debt minus our cash, gives us our net debt. Net debt right now, as compared to free cash flow, is quite high. you're looking at $33.7 billion versus a $5.5 billion in free cash flow. That multiple seems a bit high to me. I would look into that and make sure you're comfortable with the debt before pulling the trigger on this one, that's for sure. Yeah, the debt. I'm worried about the debt on that one. ROIC looking pretty good, solid double digits, except for this 2017 number here. Don't know what happened. I don't know. Average 13%. Not bad. Not bad at all. Metrics, here we go. PEs, price free cash flows. These indicate that Honeywell is expensive. Debt, again, debt's high compared to free cash flow. Revenue growth is down. Earnings and free cash flow growth is up. I would look into the discrepancy here. Why is revenue down but earnings and free cash flow are up? Why are they different? That's something to look into. Shares outstanding coming down. Good. This is not as good as coming down a company buying back their shares at an undervalued price. Honeywell is buying them at what appears to be an overvalued price, which I don't necessarily like, but I'll take it. I'll take it. ROIC over 9%. It is 12.6. Good job, Honeywell, doing that. Free cash flow net income growth, I said 3% a year. They could probably beat this. They could probably do... I would be comfortable with 4, even saying 4%. But revenue growth slowing down so much scares me. I don't understand why they're able to grow free cash flow and net income and not revenue. So I'm going to be extra conservative here and say 3% on down the line here. 15 price free cash flow and 15 PE multiples. That's a number that I like to go to. It's the market average. I feel comfortable with assigning a market average to Honeywell. There are a few companies out there that I don't really feel comfortable with. The ones that I look at anyway, I'm usually comfortable with a 15, so you'll see me use that a lot. I've used it before in other videos. Anyway, $150, $149 based on free cash flow. Based on a net income, you're looking at about $160. Over here you can see we're averaging them together. Your current price is $197. Here's your two price targets. We split the difference, average those two, $154.24, so that we have a singular number for forecasting. Coming over, you're in at $197.04. You get these free cash flows. You're out at $154.24, and you only get 3% a year. Yeah, not a whole lot to say about Honeywell. I expected this to be a lot better. I expected their company to be doing a lot better, growing faster, for the stock to be cheaper. I don't quite understand why this stock is overvalued. I have a hard time wrapping my head around why this company would be overvalued. It's such a boring company. I don't get it. Yeah, so in the end, my conclusion with that is that I'm staying out of Honeywell. I think it's a good company. I think it's a good business. A good sort of industrial company. But 3% is definitely a lot less than what I'm looking for. So, on that note, I'm staying out. Other than that, I don't have anything to say. So, I will end the video here, and I will catch you guys in the next one.